How does wholesale funding work in shadow banking? Imagine a world where financial companies can lend money without relying on traditional banks. That's what shadow banking is all about. It's a system that operates outside regular banking rules but still plays a big role in the economy. Now, how do these shadow banks get the money they need? That's where wholesale funding comes in. Wholesale funding means these non-bank financial firms borrow large sums of money from big investors like pension funds, mutual funds, and other institutional investors. Instead of taking deposits from everyday people, they raise funds in the open market. They do this by issuing short-term financial instruments such as asset-backed commercial paper, repurchase agreements, medium-term notes, and bonds. These are all ways to borrow money quickly and in large amounts. The process starts when a shadow bank, like a finance company, makes loans to consumers or businesses. These loans are then bundled together into securities called asset-backed securities or collateralized debt obligations. These securities are sold to investors or kept temporarily in special purpose vehicles or conduits. To finance these holdings, the shadow bank issues short-term debt instruments like asset-backed commercial paper or repurchase agreements, often backed by the loans themselves. Investors such as money market mutual funds or other wholesale market participants buy these short-term instruments because they want liquidity and low risk. Even though the underlying loans might be risky or difficult to sell later, these investors trust the short-term instruments to be safe and easy to cash out. This chain of borrowing and lending allows shadow banks to transform risky, long-term loans into liquid short-term liabilities. They can then sell or roll over these liabilities in the market, giving them the ability to lend more money. This process is called credit, maturity, and liquidity transformation. It helps provide financing for mortgages, consumer loans, and corporate credit. However, relying on wholesale funding can be risky. If investors suddenly stop buying these short-term instruments, shadow banks might struggle to pay back their loans. This could force them to sell assets quickly, which might cause prices to fall and create instability. Looking back at history, shadow banking grew rapidly before the financial crisis of 2007 to 2009. It provided a lot of credit through securitization and wholesale funding channels. While it helped expand credit, it also made the financial system more fragile when funding dried up. This history shows how important it is to understand the risks involved in this kind of funding. In simple terms, wholesale funding in shadow banking is like borrowing big chunks of money from the market to finance loans and investments. It's a vital part of modern finance, but it also requires careful management to avoid potential problems.